Welcome back. You're still tuned into Chartbusters on CNBC-TV18. The other stock on our radar today is Anup Engineering. Reported good revenue growth in the fourth quarter. Margins contracted. Net profit declined because there was a provision reversal of taxes in the last quarter, and that's why it looks optically lower on a YOY basis. The numbers, however, are largely in line with the management's guidance. Punit Lalbhai, the Vice Chairman and Non-Executive Director of the company, is joining in now to discuss the quarter gone by and, more importantly, what is the outlook going forward. Mr. Lalbhai, good morning. Thank you so much for joining us. Well, the first question is on the outlook, because in your presentation, you say that the order book is strong and inquiry pipeline is also very strong. What is the kind of order inflow that you're expecting in FY24, and what would it do to your top line and your margin growth?
Good morning. It's a pleasure to be here. Thank you for your question. We are in an environment where the capex cycle, particularly in petrochemicals, oil and gas and chemicals, is on a high. And we see this trend continuing for the next 2 to 3 years. So that's what's driving the strong order book. So we have, in terms of, FY24, we have a full order book in place. We have an opening order book of around 530 crores, and we continue to book orders as we go forward. So all orders that we will book now actually will be for year 2025. So 2024 is pretty much full in terms of our order book.
So the 530 crore order book that you've ended the year with, or rather opening the new financial year with, will entirely be executed in this year itself, right?
So it's, one has to understand that our industry is one that has very long cycle times. So not all of the 530 crore order book that we opened with will be executed this year. Some of that may spill over to the year after, but there might be some short cycle orders that we have already booked in Q1 that actually come in this year.
That's exactly what. That's exactly what we were coming at. In terms of revenue, how much revenue do you think you will do in this year?
Yes, so our revenue should be around that, very close to that level.
500 plus minus a bit, right?
120 odd plus minus.
Okay. What about your margins? 20% in FY23. Out of the order book split that I was looking at, you get the most from equipments, there's heat exchangers. Is there a margin difference in all these segments? What is the margin outlook?
The margin outlook is around that 21-22% mark. Last year was an exceptionally low margin year because we saw some very unpredictable and fast swings in raw material, especially around that Ukraine conflict period, which sort of resulted in us having to cover material at much higher than expected prices. But now that is pretty stable, and we expect some improvement in margin. But I feel that 22% is what we should sort of be gunning for in quarters to come and even years to come.
Okay. Just to follow up on that, I wanted to understand if there's a margin difference in any of your segments or your geographies as well. You are speaking about lower raw material costs, so that is something that will aid expansion. Any category expansion or geography expansion that will do that for you?
So we are targeting higher exports. Exports generally come with very similar margins to our strong domestic customers. So as far as products, which are, I would classify products into two buckets. One is heat exchangers and the other is vessels. Both have similar margin. They have different lead times of manufacturing, and they have different requirements in terms of manufacturing capability. So with the addition of our Keda facility, we will be more and more geared towards doing more vessels in addition to heat exchangers. So our ability to switch between the product categories has been enhanced by the coming online of Keda. And we are also looking to increase our footprint in exports and take it to around 25-30% from the current 18-19%.
All right. You actually preempted my next question. This is with regard to the Keda facility. It took a long time for that facility to actually come on stream, and now that trial production has happened, just wanted to understand what's the peak revenue potential of this plant? How much incremental orders can you take by virtue of having this plant ready? And what could the additional revenue be?
So we had sort of intentionally slowed down Keda during COVID in a very uncertain environment. And that's the primary reason why it took long to come on stream. Now that it has come on stream, let me tell you that we've only invested phase 1 of Keda, which is 1.5 bays of the overall 7 possible. And the 1.5 bays should, when optimally utilized, result in a turnover of around 150 to 200, anywhere in between that.
By when would that be? What is the current capacity utilization, the initial days that is? And at peak, when will that peak be reached? That's exactly my question.
Now that we've started trial production, we estimate that the first orders will leave sometime in August, September of this financial. So essentially, we have only Q3 and Q4 this year. So we are targeting between 50 and 60 crores of turnover, because it's going to take ramp-up time. Most of the dispatches will happen in the second half of the year. But the full potential, we should come close to the full potential in the next financial year.
You know, what's interesting, Mr. Lalbhai, is over the last 1 month or so, the stock price has rallied by about 40-odd%, and that coincided with the promoters buying from the open market. And this is something that you've reported to the exchanges itself. They've been buying a little bit, from the open market itself. Just wanted to understand what your plan is. Do you intend to increase your stake by as much as you're allowed in this financial year? The promoters are ready buyers. What's the scene here?
Well, without directly answering that question, I would like to say that we are very bullish about the overall scenario that this company is in. We are seeing a very strong capex cycle. We have an excellent management in place with Reginaldo D'Souza taking over and Rishi having done a great job for us. So we are seeing a very stable and excellent management team. We are seeing our capabilities being enhanced by Keda, and we enjoy a very strong execution track record in terms of on-time delivery.
Okay. All right, Mr. Lalbhai, it was a pleasure speaking with you. Thank you so much for joining us. That's the word coming in from Anup Engineering, expecting 21 to 22% margins in the next year with top line of around 520 crore rupees. The Keda plant that will come on stream will also add to revenues this year itself. We'll do one thing, slip into a short break and get you more on markets and stock-specific action on the other side. Stay tuned for that.